Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to delve into this with regard to how to construct a portfolio. One of the things that I do with clients, when the first time clients come in, we do when we're doing our retirement income analysis, is we get into, of course, an investment analysis in which I dig down into what their current portfolios look like, what their funds are. All right, as I mentioned, there are 33,000 different funds out there, and I went through real quickly the formula that I use, or a filter that's easy to eliminate most of them. I eliminate active management. I eliminate, because I know it doesn't work, I eliminate funds that have loads on them, because I know we don't need to spend 4, 5, 6%, almost 5.75% typically on a front-end load. That comes at 5%. Imagine that. You put in $100,000 and there goes $5,750 out right up front on a fee. So we don't want to do that, right? So one of the things we can, and we don't need to, there are no load funds. Now, even with no load funds, though, we got to understand no load funds doesn't mean that they don't still have fees and costs attached to them. And if they're actively managed, these costs can be quite high when you get into trading costs. And we've talked about the bid-ask spread, that amount that is made by the market makers every time a stock is bought and sold. So we got into a lot of that last week. Don't want to get into too much, but one of the things I do want to set up, there was a recent article that I came across, and this is from the Mises Institute for von Mises, Austrian Economics, Freedom and Peace. One of the things about Austrian economics, you're going to see two schools basically, that of Austrian economics and that of the Keynesian, which is what you hear more of in our government circles in particular. This was kind of interesting, caught my eye, because it was talking about, will Trumponomics save us from a bust? And I've got to say that in talking to clients, one of the things that I've noticed when, first off, it was amazing, right? When Trump, the night of the election, we see the market go crazy in a negative way, right? Down like 800 points. It looked like, oh my gosh, it was going to be Armageddon the next day. And then by the time we get close to market open, it was about down only 200 points. And before the day was out, it was up 200 and then climbing. And we've had this what is known as the Trump rally, if you will, since then, and how much the stock market has increased, something like, I think, close to 4% just since the election, which is pretty amazing. I've been more optimistic since then, mainly because of some of the policies that are being put out there. I've been have been concerned for quite some time that we're in for a bear market. I'm not alone there. John Bogle of Vanguard Funds, in fact, it's through the research that I do that these things get formulated. So Bogle talked about two bear markets potentially over the next 8 years. BlackRock talked about bear markets and very low asset returns on the stock market being around 4%. McKinsey, I've shared a lot of this research with you in the past. McKinsey Global International Independent Research Group, again, the same thing, talking about 4% with regard to returns on the market. Asset allocation in the portfolios I've used since 2000, so from 2000 through 2015, though we've seen returns more in the range of about 5, 6, 7%, even depending on how many equities you have in the portfolio. We're going to delve into how that works. But this is interesting on this Trumponomics, because some of it gets into, are we going to see something different? The potential here with all of a sudden a big shift, if it in fact occurs, is that we could see true economic growth, and that could help soften that concern of a bear market, a big drop in the stock market, not to mention a recessionary time to build off of, as we might normally see cyclically. So this is something we're going to be keeping a close eye on, and this is why it's important to understand investing, because if you're invested improperly, if your asset allocation is not done correctly, then during a bear market, you could see huge drops, okay? A bear market is defined typically, loosely, if you will, by a drop of more than 20%. We've seen from 2000 through 2009, 2010, if you will, the first decade, we'll call it, of this century, we had a bear market at the beginning of about a 44% loss, and then we had a bear market through October of 07 and March of 09 of about a 55% loss. So imagine if your portfolio, and that's with the S&P, which outperforms 90% of equity mutual funds. So imagine for a lot of investors, they did a lot worse than that even, or of course they got scared completely when it started dropping so badly and got out of the market, and of course then missed out on the boom that occurred after and what we're seeing today. All right, so what we're going to do is we're going to dive in. Let me do one thing first. If you'd like, for the first 10 callers to my office this morning, 615-376-5325, if you'd like to get your own personal investment analysis along with the retirement income, a full-blown comprehensive financial plan at no charge to you. For the first 10 callers, 615-376-5325, I'll talk to you about Social Security, Medicare, when to take it, what the different rules are, how Medicare works, the difference between original Medicare and Medicare Advantage plans, the costs involved, what the differences are as far as what you get on coverage. We'll get into, of course, investment analysis, dig deep down into your portfolio to see what kind of stocks, how many stocks you own, how many unique holdings, is there overlap, a lot of duplication, for instance, where you think you're diversified and you're really not, where your costs are maybe excessively high, your risk is excessively high. I'll point those out. If you got junk bonds in your portfolio, I'll show you where they're at. Long duration bonds, which are going to be very interest rate sensitive, and we are definitely going to be seeing interest rates finally start to rise. So this is one of the things you're going to have to pay particular attention to with regard to your portfolios. All of that for the first 10 callers. Debbie's standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment when you come see me so that I can do this work for you, again, at no charge. And when you come in, I'll also give you a copy of my book, 7 Steps to Financial Freedom in Retirement. I get into all of these things in the book, including the chapter 5 on how the smart money invests. Now, with no more, we're going to go right into this. So free markets work. That's the first component when it comes to this how we do the construction of the portfolios. So again, in a free market, at any point in time, the actual price of a security will be a good estimate of its actual value. So this is what we talk about, right? I used the analogy of a gallon of milk. It's going to be the same at Kroger or Publix, because what happens if Kroger all of a sudden raises their prices way up? Everybody's going to go to Publix and vice versa. So that competitive marketplace is determining the price, and supply and demand, of course, has a lot to do with that. More people want milk, the higher potentially the price of milk might be. This goes to the stocks. It's the same concept, okay? Stocks are fairly priced as well. All right, so next thing. Potential belief. If you believe that free markets fail, that market fails to price goods and services efficiently, in other words, that somehow a gallon of milk over at Kroger's is going to be half the price of a gallon of milk at Publix, then if you believe that, that's basically believing that free markets fail, that supply and demand isn't the biggest determinant. You'd also believe then that it's possible for some individuals to identify in advance which prices are inaccurate. In other words, money managers, these advisors that say, oh, this stock is definitely going to be the best one to buy, or this group of stocks is going to be the best ones to buy out of, say, the large companies. We're looking at the S&P and we say we're going to narrow it down to 25 or 50 or hundreds or 200 stocks even, instead of just buying all 500, because we're going to be available to identify in advance which prices are inaccurate. Underpriced or overvalued markets can be forecasted or predicted. Same concept, right? That we're going to be able to look out there and say, oh, this is not a good time to get in the market, or this is a bad time, or I should, I'll wait and maybe look for an entry point later. Managers seek to increase returns and avoid losses by taking advantage of stock or market mispricing. That's the whole concept behind active management with money managers that run mutual funds. People with this view would in fact then use traditional investment approaches. That's where active management comes in. If you believe these things, if you believe that there are imbalances out there, that things aren't priced correctly, that there are these smart people that can go out and know which ones to buy and which ones to avoid, then active management would be the appropriate. You would want an advisor, in fact, that believes in those same things. Now, to be clear, I'm not that guy, okay? In my practice, I have an alternate belief, and that's that free markets actually work. All right, so when free markets work, free market is the best determinant, in fact, of market prices. So we want to go to the next slide now and look at free markets work. All right, so the free market is the best determinant of market prices based on supply and demand, right? It's so simple, isn't it? People want something, the market supplies it. All right, and there you go. And that's how, if I want to run a company, in any business endeavor, if you think about it. I remember years ago reading a book, and they said the key as far as success was to determine what the client or the customer wanted, and then deliver it. Okay, it's pretty simple. Determine what the demand is, and then supply that demand. All right, that's what companies do. All available information is factored into the current price, and that's the other part. Stocks are priced fairly. I mean, what you're seeing when you look at the book value of a company, all right, the stock value pretty much, or the stock price reflects that. Now, there are some exceptions that we can see when we see growth companies or value companies, but these exceptions aren't that they're priced still fairly, but maybe price to value to book, though, might be a little different. And we can talk about that, too. But the randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. In other words, you'd have to increase risk to get a better return. And that's meaning more equities in your portfolio. People with this view, that's where free market investment strategies come in. Market efficiency does it. We're talking passive management. Now I'm going to get into that in more depth when we come back. Join us here. We're going to be right back on the Retirement Report.